Happy Bitcoin Monday, freaks. It's your boy Odell here for another Citadel Dispatch, the live, unedited show about Bitcoin and freedom tech. I'm your host, Odell. We're here for another great rip with LeClair. I'm very excited about this rip, but before we get started, I want to thank all the freaks who continue to support the show, whether that's through Podcasting 2.0. You simply download a Podcasting 2.0 app like Fountain Podcasts, Breeze, Podverse.fm, EchoLN.com. Search Citadel Dispatch, load up your wallet with some Bitcoin, choose how many sats per minute you think the show is worth to you, and then as you listen, those sats are streamed directly to my node. Using Podcasting 2.0, you can also do something called boostograms. Boostograms are comments that you leave with attached with a certain amount of Bitcoin. I read those out on air, the top four from the previous episode. Our most recent episode was actually just 2 days ago, but we already have some freaks who have supported the show. We have Eric99 with 50,000 sats saying, "This will be one of my last 50K boosts for a bit. My work is no longer allowing overtime. Was able to stack 55 hours a week and now back to 40. Sad face. I will still stay humble and stack sats, just going to be spraying less sats going forward. Thank you for the continued content." Well, thank you, Eric99. I appreciate that. Wish you the best of luck with your job. We have at MRMR or Mr. with 8,674 sats saying, "Great topics, great guest, great host, rock on." We have Ride or Die Freak, Ape Mithrander, 7777 sats saying, "Odell, time for you to take a break from stacking sats and start stacking kids. You'd make a great father given how many Bitcoiners you've successfully raised." We have at Owen Lewis with 1,000 sats saying, "Homeschooling sounds great in theory, but for 99% of people, only having one parent working is simply not feasible. Not sure how we get around that in the short term. Interesting episode, though. Thanks." I know homeschooling was a little bit out of our wheelhouse. I do think it's a tangential topic that's extremely important. I think we'll have more homeschooling discussions on the show going forward. So if you freaks have enjoyed it, definitely hit me up with more feedback, and we will be covering all those different concerns and issues. You can also listen to Dispatch through any podcasting app. You just search Citadel Dispatch. And if you do that, you can still support the show by going to citadeldispatch.com and clicking citadeldispatch.com/contribute or going down to the bottom of the citadeldispatch.com page and clicking that big link that says donate Bitcoin. If you go there, you can go to the geyser.fund page through that link. And you can see all the contributions that happen to the show. You can see the leaderboard. The leaderboard is extremely cool because the leaderboard includes both streaming sats and one-off donations. If you go, I'm going in the leaderboard right now really quick. It's really cool. You can see Ride or Die Freak Chad Farrow at number 16 on the leaderboard with 82,000 sats. You can see God Family BTC on 17th with 73,000 sats. Vake at 18th with 71,000 sats. It's pretty cool to see the leaderboard. Uncle Thinks at 7 with 450,000 sats. Anyway, freaks, I appreciate all the support. Keep it coming. I really do appreciate it. You keep putting me and Dispatch on the top of the Podcasting 2.0 charts at Fountain, which are really cool. If you're not listening through a Podcasting 2.0 app, my favorite app is AntennaPod, just FYI. Fully open source, really fantastic app. And I know it's a bear market and a recession. You can always support the show by subscribing on your favorite platform. Dispatch is available on Twitch, Twitter, YouTube, Rumble, Bitcoin TV, every podcasting app. Sharing with friends and family, leaving reviews. It really does help. Joining in the live chat. Dispatch is unique in that we have a live, unedited show with a live audience. The live chat is broadcast from Twitch, YouTube, and our Matrix chat. All those links are at citadeldispatch.com. Every link is at citadeldispatch.com. Okay, I will stop boring you with this intro. I know I'm talking a little bit slowly. It's been a long, busy day for both me and my guest. But we made it happen because it'll be a fun conversation, and Dylan's in town in Nashville at Bitcoin Park in the studio. So let's have a little fun with it. How's it going, Dylan?
Never been better, man. I'm excited to rip.
Thanks for joining me. I know it's been a long day.
Yeah, just recorded with old friend Peter McCormick. Don't know when it's released. Don't care, but yeah, just popped over.
Appreciate it. Yeah, I cornered Dylan the other day at the park, and we figured out a good time to meet up. So Dylan, I mean, I have the title at Bitcoin and Global Recession. Are we in a global recession?
I don't officially. I don't think so. I think we're headed for one. Yeah, we're headed for one. But
Officially, we're not in a recession.
I don't know. They really redefined the terms. Classic, just change definitions.
I feel like whenever I say we're in a recession, I get people commenting on Twitter, we're not officially in a recession yet. And then when I say we're going to enter a recession, I always get comments on Twitter, Matt, we're already in a recession. So you're kind of fucked either way.
Yeah, no, I mean, I think we are. I mean, because the inflation numbers. Because okay, how is a recession defined? It's 2 quarters. I believe it's 2 quarters of negative real GDP, which real GDP, gross domestic product, is defined as nominal GDP. So how much the economy expanded in dollar terms divided minus the inflation rate, right? So if the inflation rate number is cooked, then that could change the technicality of whether we're in a recession or not. Which I'm not saying it's cooked or not, or that it's just cooked this last 2 years instead of cooked throughout the last 40 years.
I mean, it's definitely cooked, right?
It's cooked.
It's always been cooked. Maybe it's
cooked.
Getting more cooked. Is it getting more cooked over time?
I don't know. I mean, there's some interesting inflation. What's that inflation gauge reading? The something index. It's I don't know.
With the CPI?
Well, the CPI,
the Consumer Price Index.
Yeah, that one. No, there's it's a shadow index or whatever. That's unofficial, but
oh right,
you know what I'm talking about? It's and it monitors city by city.
That's not the official index.
No, but I think okay, over the last 2 years, inflation is officially is compounded as 14% or something, but have prices risen by over 14% in the last 24 months?
Yes,
of course. And everyone has a different basket.
Well, I mean, even the official CPI number, the most recent one was 7.1%, which was the official cooked number.
Yeah. So I don't know. I think this recession, as in if we're in one now, or are we entering one, whatever, is going to be different from people's understanding of a recession because, well, one, I mean, financial assets have been pretty much destroyed. Not destroyed, but stocks, bonds down 20% plus, hasn't happened in modern history.
Right.
Crypto, Bitcoin, obviously down 70%, 80%. A lot of them are 100%.
Well, the Financial Times had that cool chart that they released. That was, it's been the single worst year for a combination of stocks and bonds. And then it's been the worst year for bonds ever. And then it's the 4th or 5th worst year for stocks.
Yeah. And so interestingly, for the last 40 years, I mean, the modern financial portfolio is built upon the assumption of stocks and bonds being inversely correlated during the stock market drawdown. What wasn't taken into effect and what screwed everybody in finance this last year was that interest rates were already so low. Bonds were yielding 1% or whatever the hell they were. The 30-year bond in 2020 was 1%, 1.2%. So it's you lock your money up for a 1% yield in dollar terms, not in inflation adjusted terms, for the next 30 years. So what's happened as inflation has reemerged for the first time meaningfully since the 70s, obviously bonds have sold off, and so stocks have only repriced based on not earnings, not how much the companies are expected to earn or take in, but they've repriced based on the cost of capital, which was artificially low in 2020.
Right.
So bonds, people always assume bonds are inversely correlated to stocks during a stock market downturn, but stocks are inversely correlated to bonds during a bond market downturn.
Okay.
So stocks in 08
right
fall 30%, 40%, whatever it is, 08, 09. But in that time, bonds
You
rallied.
were like 12 at that point.
Yeah, not even.
Sorry, continue.
I was like 7.
Okay.
But in that time, bonds rallied 20% because as stocks were falling, interest rates got cut, and there was deflationary forces. Like CPI was negative year over year,
right,
at some point. And so deflationary bust, bonds get bid. It's a flight to safety. Who's the most likely to pay me back out of anybody in the world? The U.S. government.
Right.
Because they can print their own money, whatever. And so for anyone like in the 60-40 portfolio, or for hedge funds, or for like, whatever, like whoever's, like pensions, whatever, they had their like flight to safety. But in this recession, or not even,
and they were presumably already holding bonds, so they were covered in that regard.
Yeah, and like not even holding bonds, but they like the Ray Dalias of the world lever up on bonds.
Right.
And so this time around, it wasn't a stock market downturn. Well, it was a stock market downturn, but it was a bond market downturn
that led first.
Like stocks were in la la land in like January, February, March, April, as bonds were selling off. So as the cost of capital was repricing higher. So all that's happened right now for stocks, and like for whether it's like Facebook, like a lot of these were like micro bubbles in themselves. Like Tesla was $1.3 trillion, right? Like that these are like large bubbles. But all that's happened is that the cost of capital is repriced upwards. So bonds reprice lower. What hasn't been priced in at all, if we're just talking about financial assets, is like an earnings side of the thing,
okay,
or credit risk, right? So what hasn't been taken into effect is like one of the biggest drivers of stock market financial asset returns of the last decade is stock buybacks. And how do they finance stock buybacks? They just borrowed money at zero.
And then bought their own stock.
Yeah,
like what Michael Saylor did, but buying their own stock instead of buying Bitcoin.
Essentially, yeah. Right. And so Apple could borrow at Fed funds plus 20 basis points, right? Like they're like basically right. The U.S. government.
Free money.
Yeah. In a world where the Apple borrowed for 30 years at like 2%.
Right.
Which is just madness.
Less than inflation.
And they locked that in.
So it was like negative rate.
Yeah, negative rate. And that was like the standard for like really post Great Financial Crisis. Was that like we had like a disinflationary economy where they're pumping money to the system, and there was no consumer inflation, only asset inflation. Conveniently, the way that our awesome financial system works is that that's not included in the inflation gauge, right? So asset inflation, housing doesn't matter. I guess rent matters, but that's a little bit of a nuanced take. So like in terms of like what we're going to see this recession, employment is still really, really strong. Like the job market is actually still really, really strong. Yeah, there's some like white collar jobs that are seeing some layoffs. But
is this the calm before that storm, or?
I think so.
Like I said on Rabbit Hole Recap this week, I was like, the recession is going to get worse, because when I asked a bunch of like my college friends and my high school friends if they've had layoffs at their non-Bitcoin businesses, they're all like, layoffs? Why would there be layoffs?
Yeah. So I mean, we've seen like to a certain extent, like the crypto bubble has burst, right?
Clearly, as is tradition. The VC bubble has burst. No more cheap money.
No more free money. So like the Ubers and the Lyfts of the world, whose business model was
lose more money every year.
More money.
Like they were scaling up their losses.
The scaling losses by design, in the sense, okay, so like I'm going to grow at all cost, acquire revenue and users at all cost, because of like this network effect type vision, right? And like the run rate doesn't matter, because there's always the next seed round. There's always the next raise.
We can raise more money. We can borrow more money. It's fine. We'll figure out how to monetize in the future.
So money's no longer free. And so that, and also like, this was like the madness of 2021 was like CPI was like, it was, as it was climbing up post COVID, it was like 3%, 4%, 5%, 6%. And the Fed funds rate was still at 0 and they were still printing money. It was like, okay, well, so money is increasingly not even free, it's negative. Like, so borrowed money is an asset, right? Like if I can borrow at 2% and inflation is 5%,
right,
and I can lock in my rate, it's not variable, it's fixed.
Right. The humble saver was punished. If you were leaving money on the table if you didn't borrow money.
Yeah, because in a world where the cost of capital is negative, and I understand that in 2022 the story was that rates repriced higher. But in 2020 and 2021, the magic, and even like post Great Financial Crisis, like that entire decade, the magic was like, oh, it was like money was free. And then as CPI started to increase, it was like increasingly negative. So why did valuations continue to go up only? It was like, well, if you like plug it in a basic like discount cash flow equation with negative cost of capital, the theoretical value of any asset on the planet is like, well, it doesn't compute. It would just like your calculator would give you like Excel would give you like an error.
Right.
But it's infinity. Like, you know what I mean? So that's why we got like,
just keep borrowing and buying.
That's why you got, fucking rock JPEG selling for $6 million or whatever it was. Like,
right. And that's why you had like condos in New York City that were just unoccupied, but people were just buying them and trading them.
And so that game is over.
And baseball cards were at all-time highs. And all the collectibles.
That, at least for the time being, that game is over. Where were we? We were talking the VC bubble burst.
Crypto bubble burst.
I mean,
stock market bubble is bursting. It's not done yet.
But like, here's the thing: is like, and I was talking to someone earlier, and I posted a little bit about it. But like, okay, if we just look at like the S&P 500, like the biggest company in the S&P 500 right now is Apple.
Right.
So Apple throughout the 2010s traded at like a 10 to 15 price to earnings ratio. So $1 in earnings that they made in a year, they traded at $15. Right. So at a 10 PE ratio, their earnings yield, if you flip the equation around, earnings to price ratio, that's your yield. So if they're valued at $10, they make $1 in a year. You get that return on capital is 10% a year. So they traded like 10 to 15 PE ratio for as a growth name. As they were, they launched the iPhone, they had all these products, the iPad, they were scaling, growing. They were trading at this valuation during the 2010s. Post-COVID, or not post-COVID, in 2018, they became the first $1 trillion business. I'm not sure that when they became the first $2 trillion business, but I believe on the 3rd of January of 2022, they became the first $3 trillion business. And again, this is a company that every single pensioner 401k participant in the United States, in the world, owns, right? Because it's passively indexed.
It's the blue chip.
It's the blue chip of blue chips. So post COVID, this company now is a $3 trillion business, and essentially like their main new innovative product is like the iBuyback. They just buy back their shares, and it's like Apple's like a deflationary stock. Like they're not really doing anything more innovative other than just like Apple's recent innovation over the last decade is financial engineering. They just borrow money, buy back their shares because they
like AirPods.
An AirPod. I guess AirPods.
Because everyone just keeps buying more AirPods.
I say this with someone. You know what? I'll give them credit. I've owned 5 pair of AirPods.
Exactly. There you go.
Okay, so never mind. My thesis is broken.
The gift that keeps giving.
But now this like Apple is trading at a PE ratio of like, I believe it was like, I got as high as like 27 or 25 or something. Right now they're trading at a PE ratio of 20, right? So an earnings yield of 5%.
Okay.
But here's the thing that like I think many people are missing, and this isn't just about Apple or the S&P or whatever. This is just like in general, when someone goes, oh, well, the stock market's 20% from the highs, it's cheap. Well, no, because Apple was trading at a 10% earnings yield while the cost of capital was 0.
Right.
Now the cost of capital is 4%, and I guess you could adjust and you could do it in real terms or whatever. But now the cost of capital is say 4%.
Still negative.
Yeah. Well,
right.
It's negative, but there's like that's CPI's year over year versus like what forward inflation expectations are.
Okay.
Like the bond people always get mad at you when you say real yields are negative. They go, no, well, forward inflation expectations.
I don't know any bond people.
Yeah.
So what do they say? Forward expectations are lower.
Because CPI is trailing 12 months.
So everyone's trading under a lot of people, the professionals, are trading under the belief that inflation will go down.
Exactly.
That is transitory.
Yep. And to give the people that are like saying, the bond people are idiots credit.
Right.
Forward inflation expectations in 2020 and 2021 were horribly wrong.
Right.
To the upside. So it could happen again, which would send everything to hell if it was true.
If inflation gets worse.
If inflation expectations were wrong to the like,
as in they get worse, right?
Well, not even if they get worse. If they just like if inflation doesn't abate, like it's priced in that inflation is going to go from 7 to.
So 6, even if inflation stays consistent,
then financial assets are fucked.
Okay,
like mega fucked. But like just to go back to the Apple analogy, and I think it's entirely relevant. Is like equities and all financial assets are relative, right? If you can earn 5% in security B and 6% in security A, they're comparable. So now that like the Apple earnings yield, instead of being 10%, is 5% because the price to earnings is 20, right? But the cost of capital is 4%. So now Apple, despite being 30 or 40% from the highs, it's actually more expensive than it was last year because the discount rate's repriced.
Right.
And so people look at Tesla and people look at Apple and people look at like business XYZ and they say, oh no, it's cheap because it's falling.
Right. It's a sale.
It's a sale, but it's not a sale because money is no longer, at least currently, is no longer free. Because energy repriced the discount rate and the discount rate repriced the valuation of everything on the planet. And so like, the title of this is like Recession and Bitcoin or whatever.
Bitcoin and Global Recession.
Bitcoin and Global
Recession.
Recession.
LeClair.
With Dylan LeClair.
Yeah.
Correct. I think the thing that I worry is that we've seen throughout history is that asset bubbles of this scale, which actually we've never seen before.
We've never seen this kind of
ever all encompassing everything bubble.
Yeah.
We've seen like relative asset bubbles burst, and there's probably like, and this is inexact, but like a 6 to 12 month lag for that to feed back into the real economy. Like all the Keynesian economists talk about the wealth effect.
Right.
And like Greenspan, when the tech bubble burst, they literally like in the Fed minutes were like talking about how in order to re-stimulate the economy, they're going to blow a housing bubble. They were talking about this in like 2002.
Right.
They're like, we're going to blow a housing bubble so that the real economy gets moving again. So when you see an asset bubble burst like this, there's the opposite effect. Like there's a lag time. But
there's a lag for everything pretty much always,
but it feeds back into the real economy negatively. And so I think the thing, like, I kind of believe that we're going to, and I don't know like how long it takes. One of the things I was wrong about in 2022 was that I thought it was going to happen faster. I was like, there's no way the Fed can raise. The Fed raised. Right. I was like, it's going to be bad. And I think it's still going to be bad. But I'm surprised that it hasn't. I guess I was surprised that
you didn't think the Fed was going to raise much, if anything, right?
I thought, well, because they outlined this. They're like, here's the playbook. Debt's too high. It's unsustainably high. We have one way out. Let inflation rip and keep rates low.
Right, and just keep the bubble going, keep the party going.
Well, yeah.
Don't tank the stock market, don't tank real estate, don't tank capital markets, and just keep the party going.
Well, correct. I mean, and I think that was.
And as a Bitcoiner, it would have been great because then Bitcoin would have kept pumping.
Yeah, just number go up forever.
Yeah.
Well, I mean, yeah, that's what. But less so about like the asset prices, which are certainly in effect, but more so in the fact that like debt burdens at this level, whether it's like federal or aggregate or whatever you want to measure, the only way out is historically is a default on the peg, which there is no peg. It's just fiat. So the only way out is a sustained period of inflation above interest rates to lower the real debt burdens, right? So like, how do I get debt from 120% of GDP to 80% so we can keep this game going? Well, you let inflation rip high for 8 years and you keep interest rates low. That's still the game, but I think what the Fed didn't understand, because if you look at what they said in 2020 and 2021, they're like, we need inflation hot, we need inflation hot, we need inflation hot. Inflation got hot, and then there was so much social pushback and political pushback, and the Republicans were like, look what Biden did,
right?
And like the Fed is ultimately, it's a political establishment,
even though it's supposed to not be.
Yeah. And so they were like, oh fuck, like we got to raise rates. Yeah. Like they didn't want to. That's why they like the first 25 basis point cut was like in February of 22.
Well, I mean, I think the the amount they've raised rates have caught pretty much everybody off guard.
Yeah, and they're going to raise more.
I mean, like Marty committed. I remember January of last year, Marty committed the cardinal sin of podcasting, which he spoke in absolutes, and he was like, "There is no shot they will ever raise." And I was sitting there, and I was like, "They probably won't raise too much, you know." But even I was way off on that. Like they just kept going.
Yeah,
kept going hard.
I mean, you could probably look. Like I probably said, like the Fed couldn't raise either.
Yeah,
and I think
they were cut. We kept saying they were like stuck between a rock and a hard place. Like if they raise, they're just going to end up tanking markets, and then they just went with that route.
So the thing is, like, I think that view isn't like, not that it's not correct, but I think it will ultimately, like, honestly be correct in a way of like, there's this lag time. We're going to see, we've already seen the valuations and all these things plummet. If we start to see employment really turn, it's one of those things where, like, once the train starts teetering off the train track, like we've seen this before where they're like, oh, like, you know, subprime's contained, or like, you know, they say these things and like 12 dudes in a room don't understand the second and third order implications of like anything they're doing.
Right. It's crazy that 12 dudes in a room is what decides this.
And they like go on CNBC like every other Tuesday and like literally like micromanage the tick by tick like stock. They're like, you know, he's like, oh, we'll moderately cut, and you see just like the futures market just
change based on like what they're wearing, what they say.
Yeah, and like they know that they're literally trying to like centrally plan these things. But I do believe that the tightening policy will lead to actually some pretty bad outcomes. Due to like one, like we said, the historic relative size of this bust, but two, and this is at a federal level, but this is like a global balance sheet thing, is that the interest rate shock, the interest expense shock, right? Like, I don't know, like anybody that has variable rate debt is like fucked,
completely fucked,
totally fucked.
And what Americans don't realize is we're fortunate enough that most of our housing is fixed rate mortgages. But globally, that's very rare. Usually people are, and it's literally their home that they're living in. And those rates just keep going up.
Yeah, like the UK,
Australia, most places.
Yeah. And so,
meanwhile, in America, like the people who have like a 30-year fixed rate, 2%.
That's a flex.
They're like, oh my God, I'm never moving.
Yeah. And that's also like one of the interesting things with housing is like, there's like no one really trying to sell.
But so there's like a lag time there, right? Where people are just hoping that it'll come back down.
And it's not like, we're not going to see 2% rates
ever until the fall of the dollar.
That's
should we speak in absolutes?
No, don't speak in absolutes. No, well, like I
love the in-persons because I could just look in his eyes and smile at him as I say it.
Yeah, like I don't really know how it's gonna all play out, like, at all.
So this is what I was like talking about with Marty on Rabbit. First of all, to the new listeners, we have a lot of listeners in the live audience right now. Dispatch has no ads, no sponsors. It's completely audience funded through Bitcoin donations. And then the second thing that makes Dispatch different is it's live, unedited, with direct audience participation. So if you're in the live chat, whether that's Twitch or YouTube or Matrix, all those links are at citadel-dispatch.com. Feel free to put your questions in. Feel free to put your comments in. You guys make this show unique. Where were we? It just distracted us.
I said I don't know how this plays out.
Oh, right. Oh, yeah. So I was having this conversation with Marty, right? And the Fed controls, their main lever is the Fed funds rate, right? Which is what they're lending money at to banks, right?
Yeah.
They're like the start of the siphon of money, right?
Yeah.
But what they can't control is they can't control the rate that people lend them money, right? And they can't control the rate, which is essentially T-bills. And they can't control the rate that individuals lend to each other, right?
Yeah.
So if inflation continues to be hot, even if they cut rates, which will make inflation even hotter, that doesn't mean like your consumer mortgage, your just average person's mortgage actually goes down in rates, right? Like those rates would still stay high, if not go up in that situation. Am I wrong there? Like I'm trying to think in my head, if inflation's running at like 10%, and I'm a bank, I'm not going to lend you a 30-year fixed at anything under that.
No.
Otherwise, in 30 years, I'm fucked.
Yeah.
Right?
Yeah. So there's the Fed controls the Fed funds rate, and indirectly because of that, they control the front end of the curve. So So like if you look at like say the 2-year treasury bill, right?
Right.
The 2-year treasury bill is like more or less it's basically the like if you the Fed, there's a thing called Fed fund futures. You can look at it in TradingView. It's the expected Fed funds rate. The 2-year treasury bill is literally just the blended average of the expected 2-year Fed funds rates. So like they control the front end of the curve. What they don't control, and this is why like QE was such a radical thing in 08, 09 or whatever, was when they started buying the long end, like when they started buying 30-year treasuries and mortgage bonds. That was a big deal because they were actually stepping up and influencing the long end of the bond market, which is like something that like they had never done.
Right.
So yeah, they control the front end. The long end is something that they don't control. And that's something
unless they're like actively participate. That's what they were trying to do, is what you're saying.
Yeah, and that also, the act of buying long duration financial assets stokes a flame of inflationary pressures. The interesting thing, and like some really smart like geopolitical strategists think that the Fed is going to restart QE or yield curve control in some form of way in 2023, like that Zoltan guy.
Right. I love Zoltan.
I do too.
He's going to be speaking at Bitcoin 2023.
Yeah, he's actually pretty brilliant and has a fantastic understanding of like money markets. Some of his theories are a little wacky with like.
That's why I like him.
Yeah, like Bretton Woods 3 and all this other stuff. But
I mean, Bretton Woods 3 is like straight dream fuel for Bitcoiners.
Yeah, it's like ditch the dollar and
move to commodity backed currency.
Yeah, like
he even mentioned Bitcoin in that one.
Yeah, I think the end of it was.
And then we started dumping, and he stopped mentioning Bitcoin.
Yeah. I think he'll come back to it. I mean, Bitcoin's the whole ecosystem's a shit show, so I wouldn't mention it either. Where was it?
To bring us back, I mean, the point I was all of this shit is way above my pay grade, which is why I brought you on, because you're just a young kid who's just obsessed with it.
Yeah.
Right. And you've basically self-taught yourself all of this stuff through the internet.
Yeah.
And just having a lot of time on your hands, and you're very intelligent. But I don't get any of this. I have a very base level understanding. I'm like a new coiner when it comes
like
to
compared to like 99% of normies, you are like so far ahead.
I know, that's why we're fucked.
But continue on.
No. So this is why I'm trying to grapple with it, because that concerns me.
Yeah.
No, so basically my basic understanding. So I'm trying to figure out. So I am at a certain point in my life where, I would obviously like to, have my own land for my family.
Yep.
My own house. I don't own a house yet.
Mm-hmm.
Right. I could use another car. My car is older than Bitcoin. So I'm driving a 15-year-old car. Right. And, I'm essentially all in Bitcoin.
Yep.
And I wake up every morning and I say to myself in the mirror, stay humble, stack sats, and then I tweet it out.
Mm-hmm.
Right. Like this is the current state of Odell. This is where Odell is sitting right now. Yeah. Right. And I'm trying to figure out what happens next. And I'm not necessarily trying to actively trade it.
Yeah.
But I'm at least trying to get like a basis of where the fuck we stand. And it seems like we're in a completely unprecedented situation.
Yeah.
We're sitting at the back end of this massive macro bull market that we've never seen in human history, that was fueled by this cheap capital.
Yep.
That was only possible because we moved to this fiat regime in the 70s, which is still relatively new in the
and globalized the entire world.
Right.
Yep.
So we've literally never been in this situation before.
Never.
So how do you look at it? Like what happens next? We're sitting here in January 2023.
Yep.
You come back to Nashville, Bitcoin Park, January 2024, right?
Yeah.
What's going on at that point? Like, where are rates? Where is inflation? I'm not asking you to, like, not a crystal ball, right? But I'm trying to, where do you see us going here? And how do you even prepare for that type of situation?
Yeah. The next 12 months is harder. The next 12 years is much easier, in my opinion. like we kind of posed at the beginning, the only solution to this massive debt bubble, because the asset, like, think of the global balance sheet, assets and liabilities. We had this global everything bubble fueled by debt.
Right.
And so the asset side up only, liability side up only.
Right.
The asset side,
because you're an idiot not to borrow money in that situation.
You're an idiot. It's the game. It's the entire game.
And then you buy assets with it, so the assets go up.
And like, I mean, I know people, I know family, like direct family, like involved in real estate and whatever, that for the last 40 years played the game. They played it magnificently. Borrow money,
buy real estate,
borrow against it,
buy more real estate,
finance it, buy more, and it was up only. And it works because the cost of capital went from 20% to 0. Not that game is over, but the game has changed in the sense that consumer price inflation emerging has thrown a new variable into the mix. Whereas for the 40 years where there was no consumer price inflation or diminishing consumer price inflation because of globalization, because of demographics, all that, that wasn't a problem. So what does the next 12 months look like is certainly a tough question. I think the labor market weakens significantly by design. People
lose their jobs.
Like, yeah, people are saying, like the mantra of like anybody that's made money in the last 20, 30, 40 years is don't fight the Fed.
Right.
The Fed is telling you don't fucking buy assets.
Right.
They're like, we're going to get inflation down and we're going to maul you in the face to do it.
This is why I'm renting.
Yeah. They're like, they're telling you.
Yeah.
And so, I mean, have they certainly been wrong or shifted policy before in both ways? Yes.
Pretty much all the time.
All the time.
Yeah.
But I think the only way they shift the policy, the only way they, like, everyone's talking about pivot. The only way that
now people are saying soft landing, like they're actually going to pull it off. They're going to pull off their soft landing and pivot.
I don't believe it.
Yeah.
I think that a pivot will come because things are bad. And I do sympathize with the crowd that's like, dude, it's all fucking tea leaves. Just like stay humble, sack.
I was giving you shit about it in February. I was like, when did this become Fed Twitter? I thought this was Bitcoin Twitter or whatever. I was like, the Fed doesn't matter. So worst take of the year.
Yeah.
I'll own that.
Yeah, no, and like I didn't like sell my Bitcoin and play it perfect. Like I didn't I got cute, shorted some bonds, did this or that, but like
how the fuck do you short bonds anyway?
Like you just short sell.
But like where? Like you go to like TD Ameritrade or something?
Yeah, or like Interactive Brokers or something.
Okay, sorry, continue.
Or like I don't know, you can like with Robinhood.
That's like so far out of my.
Yeah.
I don't even. Okay, sorry, continue.
Like half the reason I'm not like totally wrecked this year is despite like having a decent cold storage stack is like just like shorting shitco's and bonds. But regardless, like so for the next 12 months, I think inflation comes down a bit. Regardless if it doesn't or not, I think you're going to see the employment cycle turn. Just off of like all of the leading economic indicators, whatever, just like historical precedent. These things are pretty well documented. So more pain, not just in the tech names, but potentially like the cyclical names, like actual, not like Ponzi companies, not Ponzi tech software as a service companies, but like real economy type stuff.
Not Carvana.
Yeah. Yeah. It's a funny story. And so by design, right? They want to literally reduce aggregate demand, and they're doing that by tightening the belt around everyone's fucking neck. Like that's literally what they're telling you they want to do. And so I think in that world, it's going to be tough for really any financial asset that relies on inflows, passive inflows, which is every asset that relies on passive inflows. Like the financial markets have been kind of zombified over the last 40 years.
Okay.
Because like think about like 401ks, pensions, whatever. Like the stock market on a day-to-day basis doesn't trade because the company released new results and said, hey, this like Apple goes up or down in a day. Why? Not because their computers are good or bad or because people think that their earnings are going to go up or down. I mean, that matters, but it's more so like, what are the passive inflows of price agnostic buyers from 50 million Americans what are they doing? Right. Like that's
right.
like that's what fiat has done to their economy. It's just,
Right.
like, and you know,
everyone needs to be an investor.
Yeah, everyone needs to be,
because your money is shit, so you have to outperform it.
Like, say what you want
you
about.
either need to be an investor or hire an investor and pay him points to fucking do it.
Yeah, and you or pay, you know, index funds fees
Right.
to aggregate a basket of these things. Say what you want about Mike Green. He's done actually a lot of good work on the passive zombification.
Yeah, he hates Bitcoin though.
I saw him in Unchained Capital's office, like at
Bitcoin Takeover, right? Were you there for that?
Yeah, I was like,
yeah, he was a special guest. We invited him for that.
Oh, did you?
Yeah.
Okay, I was in my back on my laptop, and I was like, do I like dox Mike Green being at Unchained Capital?
He sat in the front row.
Yeah, it's pretty funny.
He'll come around eventually.
I think
they all do.
He's a smart guy. But yeah, definitely doesn't love Bitcoin. What was he saying?
Zombification of assets.
Yeah, zombification of assets.
This is your problem. You move too fast. You're just.
I know.
Your brain's going a mile a minute. Slow down. Take a sip of beer.
Yeah,
I don't know if the beer will help or not.
I'll slow down the clock. I don't know if it happens in the next 12 months. It could happen.
Well, I agree. That's always been the smart play, right? The smart play is you never make short-term bets.
Yeah.
Because short-term bets are almost always gambling.
Yeah.
Especially when you have 12 guys in a room that kind of can just rug pull you at any point.
Yeah.
On what your short-term bet is.
Yeah.
Which is how Stay Humble Stack Sats was born. That's how the whole Bitcoin thesis I have, it was born, which is this long-term thesis.
Yeah. No,
but that's no fun. So, like, what happens over the next 12 months?
Yeah. I think regardless if it happens in 2023 or not, what's going to need to happen from like a mathematical perspective, from like just basic economics, is that 5% rates bankrupt the world. And
they're currently bankrupting the world.
Yeah. And
like, didn't the UN ask the Fed to stop raising?
Yeah. Like, yeah, they're like, dude, chill.
Humanitarian crisis.
Yeah. And like the Fed controls interest rate policy for the world.
Right.
Like the BOJ, like Bank of England, none of them really matter. Like we
think it's bad because 12 Americans are deciding this shit. But imagine being in another country, because we're the reserve currency of the world. So what we do affects all of them. Yeah.
And especially like for instance, El Salvador, like why? And you know, some people will say like, oh, it's dumb to bet on like a hyper volatile tech asset, blah blah blah. Like, well, no, it's logical to seek out alternative.
Were you saying because they didn't even have their own currency, they were using the dollar?
Yeah, so
straight up.
So like, because you know, there's an economic recession, right? That happens in 2008. Things go bad, global recession. Well, the Fed comes in, stimulates. Congress comes in, passes a fiscal package. Hands that, like, not handouts, like that was more normalized in 2020, but like we'll just go to 2020. Fiscal packages, PPI, all this garbage,
right?
Stimmy checks. El Salvador didn't get that. They just got the inflation as a result of that.
Right. Yeah, we exported the inflation to them, and we gave checks to a lot of Americans.
And right now, via the tightening of interest rates and monetary policy, we're exporting our inflation to the world.
Right. I understand that much.
Yeah. And so, and like, that's literally like their goal is just
fucked up.
Is sort of like, all right, we're just going to like tighten enough to where like you guys are fucked. But like year over year, like, and this is so dumb. Like, we're literally like arbitrarily deciding what the cost of capital is by what's the 12-month rate of change of this basket of goods and services that arbitrarily changes,
right, via
hedonic adjustment. What does hedonic adjustments even mean?
No idea.
It's stupid.
I was gonna ask you.
I don't know, man. So but I ultimately think, like, whether it's the next 12 months or then 18 or 24 or whatever.
Yeah, we could talk 24 months if you don't want to talk 12 months.
At some point
within my like car and house purchasing time frame.
The car purchase window. At some point, just due to the interest rate shock, due to the real economy slowing as a result of the financial economy crashing,
right?
There will be a point of reckoning to where basically the treasury, but not just the treasury, like globally, there's a debt crisis. And like it's just a math game,
right?
Asset liability mismatch, interest rate shock,
So there's so much debt outstanding, and the interest rate on that debt continues to increase, right?
Yeah.
And then you have a debt crisis.
Yeah. We're headed, or maybe like history will view this as like in the middle, or like the second inning of a sovereign debt crisis.
Yeah, I think when like you read the history books,
Yeah,
like that chapter's already started.
yes,
Yeah,
yeah. It might have even started in COVID.
right. Maybe even before that, right? Yeah.
Yeah. Well, like depending how far you zoom out, like maybe even
It matters how good the history book is.
Yeah. Yeah.
But the chapter's already begun.
The chapter,
like when our kids are reading that history book, like the chapter has already started.
Yeah. And ultimately, I believe, we've already, like, they've already exhausted the interest rate policy. Yeah, they they're getting some ammunition back. Like some people will say, oh, they've raised up to 4% now. Like they've got some ammunition back in their belt. Well, kind of, but like even then, it's like not like real interest rates like are all that high, right? Like,
right.
And they've done the 10, 11, 12 years of QE.
It just shows how fucked it is, right? That like they go up to, it's like a 7% mortgage, and everyone's like, oh my God, rates are so high. Right?
Yeah, interest rates are 4%, and like the fucking world's burning.
Yeah.
That's a joke. But I think at some point, like they're gonna come out, and honestly, like given the factors of inflation, like there's all these really smart people I read talking about like globalization forces,
right?
And like the fact that inflation was 2% for so long, despite like free money or like near free money, was because China industrialized, all these like developing nations industrialized. We like basically exported all our cheap labor to all these like third world countries, and like in the Nike and Apple and whatever in their sweatshops like gave us cheap shit,
right?
Like, and like also we found new energy sources like the shale revolution, whatever. But we have no more like cheap energy sources, at least that we know of. We actually have like an energy deficit. The ESG policies have fucked everybody, and like we're just kind of reaping the consequences of that. And so I think at some point they're gonna have to come in, and it's gonna be like a word jargon facility. They're gonna, it'll be like a treasury stabilization fund, like whatever the hell they call it. It's gonna be some six letter acronym. It's gonna be yield curve control.
Right.
They're gonna be like, we're not gonna let rates go above 4%, or we're not gonna let rates go above 2%, or whatever like the inflation rate is, and whatever like what the BOJ is doing right now.
So what explain that? What does that look like?
So
in practice,
right now, the Bank of Japan, and they actually just changed this, as of like 2 months ago, the Bank of Japan. So they set interest rates, but they also so quantitative easing. Let's step back. Interest rate policy. They set the interest rate, like you said earlier, for like the bank lending rate. So if the bank wants to borrow money, they can go to the Fed, or they can go to the whatever XYZ central bank, and they can borrow money overnight. That's like monetary policy 1. Monetary policy 2 is QE, in the sense of we're going to come by a fixed amount of bonds of debt securities, and we're going to buy 100 billion a month, or whatever. They were doing 120 billion a month during post COVID. 80 billion of treasuries, 40 billion of mortgage backed securities. Yield curve control is, instead of a fixed amount at any price.
Okay.
Yield curve control is a fixed price at any amount.
Okay.
So instead of $120 billion of treasuries at any price, it doesn't matter if the bond yields 1.2%, 1.5%, whatever. We're just going to buy them and put them on our balance sheet. Yield curve control is, we're a buyer at this price, and it doesn't matter how much we buy. We're just going to buy it.
And you print money to buy it.
Print money to buy it. So the bond market, so basically like the BOJ, the Bank of Japan, said if the 10-year JGB, Japanese government bond, trades above 25 basis points, 0.25%, we're buying it. So and for like those that aren't well initiated in bond market jargon, or bond markets in general,
like overwhelming majority of people,
bonds and interest rates are inversely correlated.
Right.
So if bond yields go up, the bond price goes down. And so when they say we're not going to let yields go below or above 25 basis points, when they say we're going to yield cap at 0.25%, they're saying we're not letting the price of this bond, of this debt security, we're not letting the price fall below this. If it falls below it,
they're the buyer of last resort.
We print money.
Right. And buy it.
And keep the price inflated. Why do they keep the price inflated? Well, because debt burdens are too high. They're trying to inflate the debt away, and they need low interest rates to do it. It's a multifaceted approach.
They want to keep that long-term interest rate down.
They want to keep the long-term interest rate down,
right.
And they want to do that because they want to erode the real debt burden. So my belief, my thesis, I'll take another one. Thanks.
We just had Rod enter the studio, co-founder of Bitcoin Park.
Shout out, Rod. How do I open this?
It's got to be twist off. It's American.
Oh, I was about to say, I was like, you didn't go to college. I was going to show you a college trip.
Appreciate it, man. Thank you. Cheers.
We're in the middle of yield curve control.
Interesting beer. But yeah, I kind of believe, and this is like independent of the Bitcoin thesis, but this like plays a big, this like broadly, this section of the podcast plays like a big role into why I'm so bullish on Bitcoin. Why I think I would support Bitcoin and its role as like a political neutral money that no one can mess with, regardless of if the debt situation was this bad. But the finance nerd in me stumbled upon Bitcoin through this lens. And I think that's probably one of the best ways that I can communicate it to people is through this like econ finance angle is like, listen, like there's no other way out of this except printing, except debasement.
Right.
And so like,
so the debasement is coming.
Yeah.
Eventually.
12,
and like 24 months.
And people are like, like right now the USD is in number go up mode.
Right.
The Fed's tightening. It's like in political, the dollar has a number go up mode. It's just politically induced.
Right.
And every once in a while, to kind of keep the gig going, they can pull this out. But it's very, very short term because the negative externalities of the monetary tightening is going to lead to bad outcomes. So they will reverse, and they will. And I believe, and who knows, maybe putting a number target on this is a bad, not Bitcoin, but the Fed balance sheet is like 8 trillion right now.
That's crazy.
Like I would not be surprised if the decade came and went and the Fed balance sheet was 50 trillion. Like, or maybe not decade, we'll say 10 years.
Or 10 trillion by conference day.
Yeah. Fed balance sheet targets.
Okay, so let's bring it back a little bit because I'm a little bit confused, which means the listeners are very confused probably. Let's bring it back to Bitcoin.
Yep.
Let's bring it back to Bitcoin. So
I like it.
Bitcoin is a money that's independent of governments and corporations.
Yeah.
The dollar is a currency that is obviously controlled by essentially 12 people in a room, right?
Correct.
Do you think, let's talk about my strategy of staying humble and stacking sats.
Yep.
Working my jobs.
Yep.
I'm cash flow positive as an individual.
Yep.
I'm paying my expenses and then I'm saving in Bitcoin. And I'm not really, I'm price agnostic. I'm just saving in Bitcoin long term.
Yeah.
Is that a good strategy?
Yes. But I think it could be optimized.
Okay. So how do you optimize the strategy?
I think, and maybe this is ill-advised advice because next cycle is different and it's a super cycle.
There's no super cycle next cycle. You're wrong about that.
I was just steel manning it.
Okay.
I think,
but I reject that on principle because that is not why I don't stay humble and stack sats expecting a super cycle.
No, I know. I think if you just like run some numbers, on like, and the beauty of it is like that the humble sat stacker doesn't give a shit about their cost basis.
Right.
they don't care about their average price.
Because in 10 years, it should be the purchasing power. I should be able to buy significantly more cars or significantly more cows or significantly more houses for the Bitcoin I have than I can today.
Yeah. And I agree with that. But for instance, right, like if Bitcoin right now is 17K, started the year in 2020 at 6K or 7K or 8K or whatever it was.
In 2020, yeah.
Yeah. And it went to 69K or whatever.
Well, first it went to like 3,500.
Yeah. Yeah.
Yeah. But then, yes.
March 13th.
Right.
But like if you DCA'd that, and let's be clear. Like, I'm not like saying DCA is bad or whatever. Like
you sounds like you're saying that. Continue.
No, like, oh my God. I saw like 3 months ago, it was like Udi was like fucking like saying DCA was dumb.
Yeah.
And then he was like,
I'm blocked. Continue.
And then no, it was funny. He was just like he was like, if you DCA'd Solana, it would be better. And then Solana went down like 90.
Literally everything he shilled is just got rug pulled. So continue.
No, oh my gosh. But I just think like the volatility of Bitcoin in both ways.
He also said like the best Bitcoin privacy tool was wrapped Bitcoin using Tornado Cash.
Yeah, oh boy.
Yeah. Anyway, continue. You're DCAing. You don't like DCAing.
No. Like I have a small DCA regardless hourly.
Okay.
It's not my stacking. It's not.
You heard it here first, freaks. He's staying humble and stacking sats.
I am staying humble and stacking sats. But it's not all of my powder.
Right.
Like my cash pile is growing.
Right.
And so, yeah, I think it's in the staying humble and stacking sats below all-time highs, and especially 70% below all-time highs is a win. Massive.
Historically, it's always been good.
Well, if the assumption is Bitcoin makes an all-time high again, or like,
do you not think Bitcoin's going to hit an all-time high? So we hit the sovereign debt crisis. Where does Bitcoin stand in that situation?
Well, what comes after the sovereign debt crisis, and a debt crisis presumes like a deflationary bust,
right,
of sorts, whether it's in a real economy or financial terms.
Okay, so what does that look like?
It looks like global monetary authorities, fiscal authorities printing.
Like the Fed just starts printing like crazy.
Yeah. And it'll be like, maybe it's the CBDC, right? Like maybe that's the play. Well, not the play, but like maybe that's their play is like, I mean, like
you launch a CBDC and then you say, if you download this wallet, we'll just helicopter money you and just send you money directly to your wallet.
Like in the way that COVID was like this is one of my actually like biggest conspiratorial rabbit holes.
Let's go.
And I think I mean honestly, maybe you and Marty like kind of planted the seed in 2020 as I was binging all the rabbit hole recaps. But Fed 10 years post QE, we've greatest bull market in history. The Fed starts to taper their balance sheet. Things are going good, but not great. There's the taper is going to be, what do they say? It's going to be like, Yellen said it's going to be like watching paint dry. 2018, December, corporate bond market freezes up. Tech stocks crash. The Fed says, okay, they get rates up to 2.5%. They start cutting again. They're like, all right, shit, sorry guys, my bad. They start cutting again. We're like, that was a little too much. Markets recover, tech stocks recover, bond market gets a little unfrozen. Going into 2019, you start to see the yield curve flatten, which the yield curve is the spread between like a long duration treasury,
a 2-year government loan to like a 30-year government loan, right?
Yeah, or like the 2-10 spread, right? So if the yield curve, the 2-10's inverted, that means the 2-year treasury yields higher than the 10-year. Okay. So the 10 years at 3%, the 4 years at 4%.
You get paid more to give a short-term loan than a long-term loan.
And that is indicative of something in the financial system or the economy kind of being out of whack. There's like a whole bunch of reasons.
Because usually you should get more money for doing a long
in a logical world.
Right. Like if I was going to personally give you a loan,
you'd want more for a longer duration.
Right. If it's 30 years, who the fuck knows what's going to be happening in 30 years.
Yeah. So when that's inverted, like there's problems. And historically in the United States, every time the 10-year and 2-year is inverted, that predates a recession.
Okay.
So that starts to really flat, and then it actually inverts. I think like intraday it inverts.
Right.
And it was like, oh boy, like this is a big thing. And then like 2 months later, the repo market blows up. Like, so the overnight rate for banks to lend, not to the Fed, but to each other.
I remember that.
And there was like this big thing, and it was like they shot up to 8%. And it's like basically it was a telltale sign that like liquidity in the banking system was really, really terrible.
Right.
And so the Fed comes in like the next day or two, and they were like, okay, this is like a temporary repo facility where like we'll inject the system with some liquidity, but like guys, it's not quantitative easing. It's not QE. Like it was QE.
Right.
But it was like a different facility, more jargon. They called it like RR, like repo, blah 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 blah. Right. I don't even remember what they called it.
Repo market operations.
Yeah, it was something stupid. But their balance sheet was expanding. Like and stocks started to melt up again. All of a sudden, and like this was like, you know, the not QE kind of thing was.
This was like obvious. The end of 2019.
Yeah, right? And this was pretty obvious to anyone that was paying attention. All of a sudden, you start to see CEOs just everywhere resign.
I remember that. Yeah. And
there's this mysterious virus in China.
Yeah.
And they're like, no, guys, it's not a big deal. Like, don't worry.
Yeah.
And then gets to the US, you know the drill. Like, oh, this is a big deal, actually. Right. Lock down the world. Like, boom, print $10 trillion everywhere.
And you like see the chart. The chart's crazy. It's just straight up line.
Straight up.
Yeah.
And they're like, oh, like, but we had to. It was like an emergency.
Yeah, we had no choice. Lives were on the line.
We had no choice. And go down the Whitney Webb, Marty rabbit hole of like Event 201 and all that shit, where they were planning this in 2019. BlackRock in August of 2019 is like, guys, during the next recession, we're going to have to give money directly to the people because we've exhausted monetary policy 1 and monetary policy 2. What is that? We've exhausted interest rate policy, rates are at 0, or like the next downturn, rates will be at 0. They were at like 1%.
Right.
And we've already printed money and stuffed it in the bond markets. We can't do that anymore. Like it's already pretty bloated. So what are we going to do? Well, we'll have to give money directly into the hands of individuals. And they wrote this in 2019. 6 months later, oh, wow, just like a black swan event comes out of nowhere. And, you know, this thing like somehow mistakenly just like leaks out to Wuhan. And, you know, here we are with COVID. So, I mean.
So what does this have to do with staying humble and stacking sats and optimizing that strategy?
Okay. To go back to that. How did we get to this?
I don't know. Did you finish your point there?
Well,
you're just saying that COVID could have been used as an example, as an excuse to print money.
COVID was used as an excuse.
Right. The COVID crisis could have been created to cover it.
The COVID crisis was created to cover it.
Right.
And so
it was definitely used as an excuse for sure.
Yes.
Because that's what happened.
Yeah.
Yeah.
I'm maybe taking a step further here.
Right.
Regardless of that, they successfully kicked the can for like 18 months. And now we're going into this kind of next downturn. We're in the early innings of it.
Very early innings.
Very early innings. But I think it could happen faster than most people think.
Gradually and then suddenly, as Parker always says.
Yeah. But let's be clear. Like nothing has been resolved. Nothing was resolved post Great Financial Crisis. Nothing was resolved post COVID. Like it's actually
2020.
Like this, it's actually worse than it's ever been in the sense of debt burdens, interest rates, and financial asset valuations. It's worse than it's been. It's not better. It's worse. And so the solution, or not the solution, but like where we are, not like nothing has been solved. Like anybody that's saying that like we're in a good place now is wrong, in my humble opinion. And so I ultimately think that logically, like the solution, or not the solution, but the response to whether this happens in 2023 or 2024, or like kind of like this hyper volatile boom bust pattern, not in Bitcoin, but in the real economy.
Well, Bitcoin's not part of the real economy.
Well, no, it is. But like, what happened in Weimar, Germany?
Okay.
During the bust. If you look,
I remember that.
Yeah, we were there. When you look at the price of paper marks in gold terms,
right? Dylan was like -80.
Yeah, it was like -80 then. It was up only, and even on a log scale, it's just like parabolic on a log scale. But if you looked at the month-over-month change, the year-over-year change, there was multiple 85% drawdowns. And so like why was gold drawing down so much? It's not like gold was a hypervolatile shitcoin. No, it was the and it's like the situation is very different. Like Weimar had
So you're comparing right now gold during post World War I Germany, hyperinflation, to Bitcoin, current US potential hyperinflation, right? That's what you're comparing here.
In a sense, yeah. And like where right now, I think the boom and bust of the real economy are happening faster, despite like we had the 10-year bull market, or the longest bull market in stocks ever post Great Financial Crisis. The current boom cycle we just had was like one of the shortest ever. It was like 18 months,
right?
Before
inflation. Right, the 2020 collapse to
the peak,
to the top, to the bottom, to now.
Yeah. And I think this decade will be characterized as like kind of like deflationary shocks, like the pendulum, right? If you want to think of it like this kind of spectrum of like melt up, asset boom, and downturn, economic drawdown, asset bust. I think that pendulum is swinging faster than ever, and it's almost like more volatile than ever in terms of like the debt cycles, because there's so much debt involved.
Okay.
And so like the pace of that metronome between those left and right tails of like the right tail being hyperinflationary melt up, like literally like disaster hyperinflation,
right,
and disaster hyperdeflationary crash, sovereign debt crisis. Like those as the two left and right tails, I think are more likely than they've ever been.
The world is volatile.
Yeah, the world is more likely.
Like the least controversial statement ever, I think, right now.
Yeah, but I think we're towing the line between those more than we ever have. And not that I'm rooting for either outcome or I expect either outcome, but I think that when you get to where we are today in terms of the debt burdens, that's just the natural outcome, is that these are increasingly becoming binary. And really, it's not even binary. It's like a singularity in the sense of it all ends in debasement, hyper debasement,
hyperinflation.
Yeah, like that sounds. Yeah, like, and I'm not. I think
the hyperinflation chapter already started as well in the history book.
Yeah, well, yeah. If you're looking at like a 500-year view or something, 100 year. I mean, yeah.
I mean, when my kids are reading the history book, like hyperinflation's already started.
And I don't think we should want it to start. Not that we're.
I mean, I don't think we have to say that disclosure every time. Disclosure. We don't want the world to devolve into chaos.
Yeah, yeah. But I think, yeah, we're in late stages here. We've had the boom time. The bus has started. People are still pretty.
Okay, so how do I optimize staying humble and stacking sats?
Yeah, I mean,
that's how we started. You said it can be optimized. How can it be optimized?
I would say next time Bitcoin makes an all-time high and then doubles again after that.
Yeah.
Slow down the DCA or stack some cash, because everyone's going to say this time is different.
Right. Well, I mean, that's obviously a good policy, but
everyone's going to say this time is different.
Yeah, when Matt comes out, when I'm all caps, like wait 3 months and then, take some off the table potentially.
Because I think
I probably won't, but
it's almost like self-reinforcing in the way that like people are gonna be like, okay, the dollar's actually going to zero, which on a long enough time frame is correct. The dollar is going to zero. Bitcoin is approaching infinity in dollar terms. The speculative attack thesis of borrowing dollars, which creates more dollar supply, like the Pierre Richard speculative attack piece, that's correct. You have 20 Michael Saylors that are all bigger whales doing the same thing he did.
Right. He's a billionaire, but he's a small-time billionaire.
Small fish billionaire.
Yeah.
And when the chart literally is up only parabolic, and looks like the dollar is going to hyperinflate to zero, then we're going to crash 85%, and it's going to crash the
like it happened in Weimar with gold.
Yeah, and like,
but the people that just stayed humbled and stacked bars or coins, like they were good.
Yeah, yeah, just like don't put your money in,
you need to be able to survive.
Yeah. But also like there's going to be people that come in at, like people that realize, okay, like Mike Green's going to come in and like 6 months before the gig at top and be like, all right, I'm gonna start my DCA.
Right.
And he's gonna be underwater for 4 years.
As is tradition.
Yeah. So
that's how you're supposed to come into Bitcoin.
Yeah, exactly. So basically I agree that the DCA strategy for the average pleb is great.
Yeah, like if I'm not gonna go onto like interactive brokers and short bonds, like what? And then like so like okay, cash pile. Okay, I am not.
Do you have cash?
Yeah.
Okay.
I have to pay rent in dollars. We have like Bitcoin Park is a crazy endeavor. All of our expenses are in fiat.
Mm-hmm.
Some of my income is still in fiat. So, any income that comes in Bitcoin does not get sold for cash.
This is a different question. Do you have any income denominated in Bitcoin?
No. I mean, maybe the freak sending sats and podcasting 2.0, but it's not like it's price set in that.
Yeah.
We did for Rabbit Hole Recap. We had some podcast ad deals that were in Bitcoin terms for a year.
Nice.
Which was brutal this year.
Yep.
Yeah, I guess. Yeah, maybe. Yeah, so like a minor amount is denominated in Bitcoin, but usually it's denominated in fiat and gets paid out in Bitcoin, or I'm getting paid in fiat and then I have to actually manually convert it. So I do have some cash, but if you did percentage wise, like the operating cash I have in a checking account or under my mattress is, less than 1% of my net worth. It's just something to carry me, right? So that if Bitcoin falls, I'm not in a really bad situation.
Yeah.
But for all intents and purposes, I'm way, way, way all in Bitcoin.
Yep. Mad respect.
But like where else? So like let's unpack this a little bit, right? I mean, you keep doing disclosures. We don't want chaos. I obviously I'd prefer if we didn't have chaos. I think a key thing that people should realize is if we could trust our institutions, our governments and our corporations to manage the world, you wouldn't need Bitcoin in the first place.
Yeah.
You wouldn't need the free and open source movement in the first place. Like the whole reason you need these trust minimized solutions is because trust is breaking down in our institutions. And in a world where trust is breaking down, people are going to look for tools, including Bitcoin, that don't require that trust.
Yep.
And that's the core thesis, right?
Yep.
Now, you keep saying the disclosure, we don't want to see chaos. I'm going to say the disclosure of I consider you a good friend and I have a ton of respect for you, but I want to drill in harder here. Like, so you have cash, right? You keep it in a bank. Like there are going to be bank runs, right? Like I think like Bitcoin.
You see what the FDIC
like
said?
Yeah, like quote unquote crypto, like they lead everything else is what's happening now in like macro environments. Usually what we see is like, okay, 2020, Bitcoin fell first. And then the stock market started going down and they kept shutting off the stock market, right? They just like kept shutting it off. So the stock market went down slower, obviously, because they were just turning off trading. They're like, no trading, you can't go down. And then the stock market collapsed and then Bitcoin rebounded first and then the stock market rebounded, right? And so this year has been the year of bank runs in quote unquote crypto, right? Mm-hmm. Like we've seen insane bank runs. I think that's the lead up to bank runs in the real world, right? Or like traditional finance, actual banks. And if you type into DuckDuckGo or Google, list the bank failures in America.
Yeah.
The list is insane. But what happened was, so we had a good friend, Jason Brett here, and we were sitting in Bitcoin Park.
He's like a former FDIC guy?
Yeah, and we were sitting there in the other building at this Bitcoin Park campus, and he pulled up on YouTube the IndyMac bank run in 2008.
Yeah.
And what happened with IndyMac was it was this California bank. They had over $1 billion in withdrawals and they couldn't survive. And the FDIC took it over. As soon as the FDIC took it over, everyone was like, well, now the government's managing my bank. We're fucked. So then the bank run intensified. Like people got even more crazy. So what they did after that was when banks failed, when small banks failed, they would basically backdoor do a deal where a larger bank would acquire the bank. So if you go on DuckDuckGo or Google or wherever and you type in list of bank failures in America, the list is like 130 banks long.
Yep.
Like this is not some like foreign. They've been failing this whole fucking time.
Yep.
But they just keep getting acquired by larger banks. So now we have like 5 banks or whatever for all intents and purposes. We have like 5 banks in the U.S.
Yep.
They have no reserve requirements.
Nope.
They do not have any money there. And we live in an age of social media and panic where like, who even fucking knows how quick that could turn if people just started to lose faith in those banks. So it's like, where do you put your money? And then at the same time, so like, will we see bank runs? And then if we don't see, I mean, yeah, will we see bank runs? And then, you know, what, as that loss of confidence happens, you mix that with the fact that we just found out that everyone's been trading paper Bitcoin. Whether you were Barry at DCG or FTX or Celsius, like there was just all this rehypothecated paper Bitcoin. So is there actually any Bitcoin to go around? And you combine the two, and all of a sudden you could end up in a situation like I am too humble to sell my Bitcoin, which is a weird thing, right? It's because I think we're entering a global recession, potentially a depression.
Mm-hmm.
But at the same time, I feel like I could wake up at any morning and people just like all of a sudden they realize there's not enough Bitcoin to go around and that Bitcoin's the solution to the shit because I can't trust the money in my bank.
Yep.
And so then I just end up in kind of like a paralysis or like a zen where I just go, okay, stay humble, stack sats.
Yeah. Well, like, and I agree that the banking system consolidation is insane.
It's scary.
Also, like if you just look at, if you want to like an instance of a bank run, and it hasn't yet failed, but like if you look at Silvergate's stock.
Well, no, Silvergate was actually impressive.
Yeah. Because
Silvergate, my understanding of Silvergate is that they're a regulated trust institution. So they actually had reserve requirements. They were supposed to be keeping 1-to-1. Well, like Citibank doesn't have to do that shit.
Okay.
So Silvergate actually had $8.1 billion withdrawn from their deposits.
Yeah. And
they had like an 80% drawdown in deposits. Like 80% of the money that they were holding was removed from that bank.
Yeah.
And they were able to pay it out.
Yeah.
Like who knows if they continue to survive. I'm not going to like.
They had to sell their securities portfolio.
Right.
But they did it.
They lost a shit ton of money.
Yeah. But not every bank could do that.
Right. But they survived.
Yeah.
If Citibank had 80% of their deposits withdrawn, the only way they survive is if the government prints money and saves them.
Yeah. So there's $9 trillion of FDIC insured deposits in the U.S.
How much?
$9 trillion.
Okay.
I believe there's $200 billion of.
And the only way your money's insured is if you're a poor person, because it's only up to $250K.
Yeah.
Which like doesn't really buy you that much anymore.
No. So yeah, I believe off the top of my head,
I'm gonna get shit for that. You're not poor if you have less than 250K in savings, but I'm just saying, like if you're someone,
humble,
if you're someone sitting there, if you're a small fish billionaire, right, and you're sitting there and you have, you know, $3 billion in net worth, like where do you put your money?
Yeah, I mean, you certainly have a Bitcoin allocation. I don't see why you wouldn't have a Bitcoin stash fund, even if you didn't even believe in Bitcoin. Like, why wouldn't you have? Because like I mean, they don't understand it is why they don't have that.
Okay, but continue. So we have how many trillion in FDIC insured deposits?
They have $9 trillion in FDIC insured deposits, and I believe the number is it's either 120 billion in insurance or 200 billion in insurance.
Okay,
insuring the $9 trillion.
Right, you were mentioning it earlier, and I cut you off with Jason Brett, like the FDIC meeting where they were like, which is a publicly broadcast meeting, just no one watches it because it's super boring. They're like, what if people realize that like we can't do anything?
He's like, yeah, people need to understand there will be bail-ins.
Which is when they take a haircut where they just take your money.
Yeah, it's like what happened in Cyprus,
right?
In the post-Great Financial Crisis. They were like, the Cyprus banks had a run; they were insolvent, and so your balance said $100, and they didn't have it, and they took your money to recapitalize.
Right.
So yeah, I mean, you're making me nervous about my my T-bill my T-bill position right now. Yeah, and that's the risk, right? We have to maybe be careful because inciting a bank run is a felony. So
I'm not inciting a bank run.
I know, I'm kidding. I'm kidding.
Comes on my show and accuses me of a felony.
After Friday, that's okay. But not
No.
I will say, out of all the felonies I to get accused of, I didn't expect a bank run.
I'm kidding. But yeah, no, I agree. These things can spread really fast on social media. The fact that the talking heads in suits in their stupid little meeting are actually discussing this is worrisome.
So are they committing a felony?
No.
Yeah, they're fucking telling people you're fucked.
Yeah. Well, they write the rules, so who knows? But I mean, like in that instance, if that happened, right, or any of the doomsday, recession scenarios, then they're just going to print the money. It's going to be a Congress XYZ, act where they just recapitalize the bank,
an emergency bill or whatever.
Yeah, and then so like you're going to get your money, and this is both creditors and
but it'll be everyone just gets debased together.
Yeah, so this is like the thesis.
That's what I didn't get when they said bail-ins. Like there wouldn't be bail-ins.
No
situation.
No, it would. They
would just print.
There would be a bail-in that was bailed out by the fiscal authority or whatever, or like Fed or whatever it is. But this is I honestly I will say this is probably one of my favorite tweets of mine ever, and it was a reply guy tweet. But it was like hyper Bitcoinization is the greatest wealth transfer ever from fiat creditors to Bitcoin savers. So it's fiat creditors in the sense of bondholders. You're giving your money to you're lending your money to a debtor for a 30-year period, a 10-year period, or whatever, or a saver. The losers of the next decade are the bondholders and the savers.
Right, of the last decade.
Or no, well, I should rephrase this. The losers of the next decade, and even the last decade, are the bondholders and the fiat-denominated savers.
Oh, okay.
Yeah. The winners, I believe, in my opinion, and it hasn't been true of 2022, are the people that acquire Satoshis and hold it.
The humble stackers is what you meant to say.
Yeah, that's what I meant to say.
I love it. You won't even give it to me. You're like, the people who acquire Satoshis.
No, that's not why I said that. The people who stack sats. Yeah, that's what I believe. And like, who knows the timeline? I think ultimately, like, if you put yourself on a timeline, like, and this is maybe admittedly where I've made a mistake in the sense of like, giving like in 2020, it was like, guys, like Bitcoin's going to be X dollar amount in, 6 months. And it was like
tweet.
And it was right.
Yeah.
But then it like crashed again, and people like setting expectations based on price performance just
right
led to bad outcomes.
Like if someone said like 200K by conference day or something.
Yeah, that'd be pretty dumb.
Yeah, pretty stupid idea.
Yeah, in all caps too.
Yeah.
No, it happens, man. I think what do I think? A lot of things.
But so let's just unpack this again.
Yeah.
So you expect bank runs. That's we're allowed to talk about bank runs. It's not. First of all, it's ridiculous that like the concept of a bank run is a negative thing. Like in a healthy environment, a bank should be able to handle withdrawals. Like this idea that like you go
fractional reserve banking just like as a normalized concept.
Well, I mean, now that it's fractional reserve, it's a fucking issue. But like, if
they've been fractional reserve for the last century.
But you should be able to just withdraw. Like, if you can't withdraw your money from a bank, like, what's the point of the fucking bank? They're supposed to be holding your money for you.
To lend your money at interest.
Yeah.
I mean, that's if you like. This was like kind of one of my red pill, not even red pill, like black pill moments. That black pill, or red pill, orange pill, whatever. I was reading The Creature of Jekyll Island,
right,
and the origination of fractional reserve banking as a concept, and it was literally blacksmiths that would like forge the gold bars,
right?
They had like these massive safes. They'd like sell the gold bars or whatever, the gold coins, and people would come back and be like, "Yo, can you just hold these?" And they were like, "Sure, here's a receipt, I guess." And then they realized they're like, no one ever comes back for their gold. And so they just started printing the receipts and making interest on it.
Right.
And then they were like,
like, as long as everyone doesn't come for it at the same time, we're good.
And then it was like, these guys were like, oh, like we just like start printed money. Like
it's probably was pretty amazing at the time.
And then like the first time it happened where like people were like, oh shit, like blacksmith guy doesn't have my gold. And so everyone withdrew and he didn't have the gold.
It was the first bank run.
And so like, I mean, the Fed as a concept came about to like monopolize basically the coordination of cost of capital. Because if you're a fractional reserve bank and I'm a fractional reserve bank, and I say your interest rates are 1%, and I say, okay, hey guys, my interest rates are 2%, you're gonna get run,
right?
So you're fucked, and so you collapse, and then you collapse, and even if I'm good, people are like, holy crap,
I got to go withdraw,
and so then the whole thing's screwed.
Right.
So the Fed came in and like, all right, we're like, and it was really like kind of a backdoor plan by like the wealthy elite and the bankers to establish a monopoly. And they did it to like, as a sense of like, to stop the monopoly.
We're protecting the common people.
We're protecting the common plebs.
Well, so like, I mean, I was talking about Jason Brett because he's a former regulator. He showed the IndyMac thing. And then after IndyMac, at that point, FDIC insurance was $100K. So not only did they switch, and instead of FDIC doing receivership and taking over and having the government actually take over your bank, and instead they sell it to a big bank, they also raised the insurance up to $250K to try and, calm the people and be like, stop withdrawing. Because once you get into that kind of bank run momentum, it's hard to stop the panic.
Yeah.
But so like bank runs, if the word of the day, they'll probably start in other countries first. Right.
Yeah.
Like the U.S. is the strongest.
In Russia.
Right. We're already seeing it kind of happen.
Yeah.
And then it kind of comes over to America. And we see the inflationary events happen in other weaker currencies first. And then it comes over to America. So we have our American privilege gives us a delay on it to a degree.
Yep.
But I think we both expect that trust in banks will probably devolve going forward.
Yeah.
And that is a realistic threat if you have over the FDIC insurance amount.
Yeah.
Over that $250K in a savings account.
Yeah, which is why there's no billionaires with $1 billion in a bank.
It'd be ridiculous.
What they do, and this is like no better because this is again like how this stupid financial system works. The money isn't even there. They go buy, and by buy I mean they lend money to the government over a long duration of time or a short duration of time. Like the reason, like
right, they buy T-bills.
They buy T-bills or T-bonds,
right,
which is the same thing, just a technicality over length of time.
Because they know the U.S. government will just print to pay them back.
Yeah, and because, or even if it's the same thing, kind of with yield curve control, of the sense of like they're like saying they will do something, so it kind of keeps the market at bay. Like we will print if the rate gets to X level. So the market never even almost like the market maybe occasionally tests that level, but like they never fully test it because everybody kind of knows that they have the biggest stick at the table. Same way that like for a 30-year treasury, like say a 30-year treasury is valued at $100. That $100 doesn't exist today. It's like a future promise for the next 30 years to pay you.
Right.
And so everyone's kind of like, yeah, like they'll pay, and they will, but like the government as a business, like if the government wasn't the government with their own money printer and ability to throw people in prison and enforce taxation, like the government is functionally like insolvent. Like they spend more money than they bring in every single year.
Right. If they were an individual, their credit score would be horrible.
They wouldn't be able to fucking get a used car.
Right.
Right. So, but people willingly lend them money because like, and will, buy bonds for 30 years because, well, I don't know why they would do that, but
because they have nowhere else to put their money.
Yeah, essentially. And
they have a gun to their head essentially.
And that's and a lot of, the people that are buying like Japanese government bonds or really any government bonds are pensioners that are not gun to their head, but just being forcefully, their life savings are just being invested into these vehicles that are purposely losing money. So, I said I own T-bills. I own short duration treasuries. Just basically, it's a savings account with a 4% yield.
Right.
The thing that I probably lose sleep at night the most is like that, 1 day transition from like those fiat rails to Bitcoin. That's it.
The amount of time it takes to get
into
real money.
Yeah, enter real money. No, 100%.
Yeah.
I agree with you. But yeah.
So bank runs, hyperinflation, paper Bitcoin.
Yeah. Also, yeah, there's not. I mean, the Bitcoin exchange rate is the price set at the margin.
Is it bullshit?
Right. I don't think it's bullshit. I think it's just a price set at the margin right now. And the reality is like probably 90% of the float isn't available to be bought.
So, right. It's just the same Bitcoin being traded back and forth. Right?
Yeah. I mean, like CZ's turned off fees. It's just a volumizer bullshit on the only market that actually matters. Not the only market that matters, but like Binance, like if you look at like
global, like Arcane came out or whatever, it said like 92% of volume is on Binance.
And 92% of Binance's volume is fake.
Right. Because they have no fees, so there's no cost to just trade back and forth.
Yeah. That's
you
why
can even have 2 accounts and just trade with yourself.
That's why they did it.
Yeah.
So yeah, like if there was actually a flood into Bitcoin, you know, a specific catalyst, never mind a bank run. Like even if it was just like the next Fed stimulus thing, there's going to be like probably, you know, a similar type event that happened in 2020 where like the price consolidated at 9K and it was held down for 3 months. And then once it snapped really hard.
Right.
And then, you know, that's because short sellers or whatever else, or like traders trying to keep it in a range to do financial market games. But like, there's probably 2 million Bitcoin, maybe 3-4 million Bitcoin available for sale.
Yeah.
And so
probably on the lower end of that.
Yeah. And I say I went from 2 to 4 because like as prices go up,
then more gets available.
More people will be incentivized to sell. But I think at this point, and like probably one of the best parts about 2022, and just the evisceration of FTX, Celsius, Luna, altcoins, Bitcoin, whatever, everything is that the people, and I can see this in the data, and the on-chain data thing gets, you know, made fun of, like rightfully so or not. But I can see like there's price agnostic buyers and holders. Like, I mean, you can see this because your mantra is stay humble, stack sats.
Literally tweeted out every day for like the last 70 days.
Yeah. And you know, anecdotally, like 10 people, 100 people, 1,000 people that all do the same thing.
Right.
And likewise, and I can also see it in the data. I mean, you can too. You could pull the data off your own fucking node. And so those people aren't going to sell on the first 20% pump.
We've wiped out all the weekends.
They're all gone.
If you're going to sell, you're going to sell already.
If you're going to sell, you're going to sell over the last 12 months. And maybe you sell a little bit because you want to, you know, buy a new car that's not 15 years old.
That doesn't count, yeah.
So maybe a little bit. But yeah, the next time that the Stanley Druckenmillers and Paul Tudor Joneses of the world want to buy 10 yards of Bitcoin, it's going to be hard. There's not 10 yards of Bitcoin that are going to be easily available for sale.
So stay humble and stack sats.
Yeah. Moral of the story.
I'm just trying to unpack this with you. I'm like trying to figure it out.
Yeah. I mean, I don't think this is happening tomorrow, or
I like that we have Rod in here because we have 3 generations.
Boomer Gen.
So I mean, I have a couple comments in the live chat.
Sure.
Dylan, thanks for the great content. This is from Tainted Umbrella. Great name.
Love it.
Dylan, thanks for the great content on Twitter. What are your thoughts on Bitcoin price being sensitive to Fed rates and liquidity? Will adoption rate ever make it insensitive?
Insensitive to Fed liquidity?
To the Fed, I guess, in general, yeah.
Yeah. I mean, I think as long as we're in this global monetary system where there's $100 trillion of short dollar position, right? Like the biggest short position in the world is dollars.
Right.
Like if Matt, like say you bought a house.
Yeah.
You have 30 years of short.
A man can dream.
A man can dream. I'm in that same camp. You have 30 years of short dollar payments ahead of you. So you're a price agnostic. Like you are an accumulator of dollars by force. Otherwise you lose your home.
Right.
It's the same. The U.S. government is $30 trillion short dollars.
Right.
30 trillion of short dollar position.
Right.
And so there's this massive global short position, which is why, especially like to the downside, and you know, in the subsequent upswing of a credit boom, all assets, or maybe all risk assets, all financial assets are correlated to the upside and downside because of this liquidity tide. So like I just talked with this on Peter's podcast like 3 hours ago. I think Bitcoin can be a $50 trillion asset. Well, like, let's
right now it's like 300 billion.
Yeah. So like that's
pretty bullish.
It's a big statement. And some people would be like, like it goes further than that,
yeah, why so bearish?
Yeah. Bitcoin like is gonna be the global unit of account, etc.
Right.
Whatever.
Probably.
We'll meet halfway and just say it's only a $50 trillion.
Just a humble $50 trillion asset.
A humble 50 trillion. We'll say humble 10 trillion.
Okay, we could do that.
Like it can be a $10 trillion asset and be correlated with equities. And I think it should be. Bitcoin if you think about the global balance sheet, assets, liabilities, what Bitcoin has done for the last 14 years has slowly, gradually, then suddenly, and in volatile boom bust patterns, monetize on the asset side of that global balance sheet.
Right.
So there's still the liability side, there's still the asset side, there's euros, yens, dollars, stocks, bonds, and then debt on the other side of that, of which bonds are one person's asset, other person's liability. But Bitcoin's all it's doing is just monetizing and accruing value on the asset side. If we expect that to continue, then logically it will be correlated with the asset side of the bucket.
Right. Because it's the asset.
It's the asset.
Right.
Against a whole huge basket of liabilities. And to get to the asset, it has to share the same liquidity pool with global equities, with housing, with bonds.
And gold.
Like there's a reason, like during the COVID limit down days, gold was falling.
Right.
It's not because gold is not a safe haven. It's because gold's denominator is dollars.
Right.
Bitcoin is BTC USD.
Yeah. So
to answer the question, like I think Bitcoin has obviously its own native adoption waves, but when if the VIX, the volatility index for the S&P 500, goes from 20 to 50,
right,
and equities go limit down again, Bitcoin's going to sell.
Yeah,
and that's not like
is the bottom in.
Peter asked me that today. I was like, dude,
when we did our last pod, Checkmate said the bottom was in.
We did,
and we haven't gone under yet.
It's held up. What was that, like 16K?
Yeah.
Good call. I think the worst part of the price-based capitulation is over. I think we got the time-based capitulation.
Yeah, it's going to be a grind, right, in the recession.
Yeah.
Yeah, who knows? That's why I stay on one.
It's tea leaves, man. Fuck it.
But so, I mean, it'll stop being, it'll stop being affected by the Fed when it makes the Fed obsolete.
Mm-hmm.
If it makes the Fed obsolete, I guess. Am I not supposed to talk? When it makes the Fed obsolete, right?
I think I believe it's when
the dollar dies.
Yeah.
And the world is on a money that's independent of governments and corporations. That money will exhibit volatility based on how volatile the world is at any given time.
Yeah. Well, I think
because it's scarce, it should increase in purchasing power over time
as productivity increases.
Right?
Yeah. I think
that's a thesis.
That is a thesis. I think at a certain point, there will be an inflection to the point where Bitcoin's exchange rate is still volatile in nominal dollar terms, but stable in purchasing power terms. There's an inflection point from right now, Bitcoin's exchange rate is obviously impacted by Fed monetary policy, but it's hyper volatile regardless of the Fed, and it has its own booms and busts regardless of the Fed. I think there's a future where if the Bitcoin thesis is right, we get to the 10, 50 trillion, these outrageous valuations, and it's still quoted in dollars because like there's dollar denominated liabilities over the next 30 years.
Right.
It's not going away. Like it could diminish in value, but it's not going to snap and go away. It's just not.
What, the dollar?
Yeah. Like even if it inflates, it still will be.
I feel like that's what happens to my dollars. It just
snap goes away. Stay humble.
And it's gone.
That's a good meme with SBF, by the way. Someone superimposed.
It's
pretty good. But I think there's a world where the Fed is still like an active body or whatever, or still like an institution, quote unquote. And they're still like setting monetary policy per se, and this is like long term, hypothetical. But so Bitcoin's exchange rate is still influenced by the Fed,
Right.
but its purchasing power is more stable than the dollar as a reflection of a unit of account. I think that's possible.
Where Bitcoin is the stable coin. Bitcoin is my stable coin.
And the dollar, due to its like hyper volatile boom bust,
it's just patterns. Like your utility shitcoin that you have to use to pay taxes or something.
Yeah. Well, it's like think if you think of like an emerging market economy right now.
Right.
And like liras and dollars.
You hold your savings in dollars, but you pay your taxes.
Yeah, and prices are the price of your house is relatively stable in dollar terms. Your groceries are stable.
But in lira, it's completely off or whatever. Yeah. And pesos.
Yeah. I think that's. I mean, we're not talking about this decade. We're talking about like.
Are we not? Were we talking about 2 decades from now?
I don't know.
Like when you're Rod's age? Rod told me he's going to shit talk me on his pod. Search Builders and Bitcoin in your favorite podcast app and click subscribe for Rod. So we have another question from the audience.
Okay.
We have Jay Simpson. Dylan, what signs are you looking for to mark a bottom in assets? When would you deploy your cash into Bitcoin? What are you looking for? Are you going to text me that morning? Like I'm backing up the truck?
Yeah, sure. Yeah, like I don't like necessarily like need to or plan to like catch. Like I think Checkmate's call is honestly really good. And you know, I guess hindsight is 2020, so we'll see. But like, there's not a
lower with like the DCG bullshit on the recession.
Yeah, I do. I think we can go higher too. And if Bitcoin goes to 25K,
I like both think we'll go lower, but I refuse to actually trade it. I'm just
I mean, I would not liquidate Bitcoin at these levels.
Yeah.
But
I just don't know where I'd put it.
Yeah. I don't think there's no point in that. I mean, maybe a little tax loss harvest, but in terms of like what to look for or whatever, I just like kind of along the lines of this convo, like I think and I'll probably start to increase the DCA in terms of like as a percentage of the cash pile. Like,
is that what happens? You're just gonna like gradually go into it?
Yeah, we'll see. I think, but I think we're the dollar. I believe, and it was down today, but I think the dollar strengthens against other currencies this year. I think risk assets have another down year, and I could be wrong. And I think that these tightening cycles have shown that despite the Fed's intentions and the soft landing, hopium and whatever, that once the train starts to teeter off the tracks, everything kind of falls off the rails.
The train not.
The train's teetering. Like
I feel uncomfortable in my chair because the train just keeps moving back and forth.
Yeah.
Right?
And so like, you're going to get whiplashed off the train. That was a bad analogy. I like the train's going to crash.
I have my seatbelt on the train.
Yeah, that's good.
Because I'm staying home with stack of sets. That's the seatbelt.
Yeah, but you might still just smash your face on the next seat.
Haven't yet.
Yeah.
Haven't yet. Just surviving.
So yeah, I mean, when am I gonna? I jokingly, I kind of shit posted, but I'll honor my my call or whatever. It was like May or June of last year. I was like, add laser eyes at the bottom. It was like a shit post.
So you're gonna add laser eyes at some point?
Yeah.
When you add laser eyes, we'll probably go down another 20%.
Yeah, I hope so. I'll buy more.
It's the tradition.
Yeah. So I don't know. I'm kind of waiting for some blow up in legacy. I'm waiting for some volatility.
The only reason markets are up right now is because I said we'd probably go down on Rabbit Hole Recap on Thursday. So global markets responded.
Yeah. Everyone was tuning in. They're like, oh shit, max bid.
So it appears Jay Simpson realized that on this show, you're able to ask questions to the audience. He's taking full advantage of it, and I love it. Do you think Fed rate will go back to zero within the next 2 years?
No. I think it goes lower, but I think.
Do you think we'll ever go back to zero?
It would be quite the crash if we did. I don't know.
Do you think we'll ever be able to get a mortgage under 5% again?
Yes.
That's when?
I don't know.
I'm just trying to learn here.
You can the 2024 Fed funds is like 3%. So that's a 5% mortgage.
But that's the prediction.
Yeah.
But they're wrong, right?
That's what the bond market says. I don't know. It could be wrong to the upside. It could be even lower. Who knows?
Part of me just like FOMO into a house at 6%, 7%. You'll be the guy at 2%, 30 years. Like,
yeah.
Like maybe rates go up to like 15% or something on a mortgage.
Do your listeners know where you live?
Yeah, we're at Bitcoin Park in Nashville.
Okay. Yeah. Nashville's a different. I think real estate's like interesting because it's like not uniform. Like Nashville is relatively booming, maybe. And so maybe it's over.
I mean, the market's completely dried up. Everywhere the market's dried up.
Yeah.
There's just real estate's an interesting beast because everyone treats it like it's liquid.
But
like it's a liquid market, but it's an extremely illiquid market. Like even in bull scenarios with cheap money, you're still sitting on a house for at least 6 months before you sell it.
Yeah.
And then when in this situation where rates go up, so prices on houses should go down, what happens is you get stuck. It gets sticky where like the sellers refuse to lower their price.
Yep.
And
the buyers don't want to buy.
And the buyers don't buy. So just volume goes down, like liquidity goes down.
I think
and then so it lags, right? So right now rates are up, but prices aren't down yet.
I think that's coming.
Right. So but then as a Bitcoiner, you have this third variable, which is like what's the price of Bitcoin? Right. So you need it's fine if rates are up as long as prices are down on houses and Bitcoin's pumping.
It's like calculus, man. This is
it's very complicated.
It's a lot of variables.
This is why I brought you on the show.
Yeah,
because you're supposed to tell me when I'm supposed to buy my house, but you're not telling us. So I'm just going to stay humble and stack sats. I have no choice.
It's a good strategy.
Okay, we got one more question and then we'll wrap this up. We have Dylan, producer grind, saying, "What are your thoughts on real estate and home builders this year?" I mean, we just kind of answered it. Yeah, what are you thinking on it? I mean, you're so far away from buying a house. You're still like, you can wait a decade.
Yeah. My mom was telling me to buy a house. I should have listened to her.
When it was like six months ago or something?
She was telling me last year when I was balling in the bull market.
You look like a genius. We all look like geniuses.
I was like, Mom, Mom, have fun staying poor. And that would have been a great strategy. What are you reading?
I was deciding whether or not I was going to ask you this question, but you just put me on the spot. Andy Hahn is asking, Dylan, as a strapping young lad, how many drinks does it take to start talking Bitcoin to girls at the bar?
Oh, my God.
How does it generally go? And is it a deal breaker if they're a shift level hater?
I have stopped my my Bitcoin pitches at
you don't do it. Yeah, it's not a good idea.
I mean, maybe I'll get to it later in the night.
Have you ever done the meme like in the bull market where you're like screaming in her ear?
I literally did that in like high school, bro. I was like 18 years old at like senior year, like grad parties, just like so passionate. Like I've
been there
it was like 2019. It was the 3K to 12K pump. Like that was like my graduation summer. It's just like, I was just like,
yeah, that must have been insane.
I turned 18. And it was a shitcoin model, but like I turned 18, Plan B launched Stock to Flow. I'm like a math guy in high school, and I like had already been looking at Bitcoin a bunch, and I'm like, oh my God, linear regression, log scale. Like I like that the Plan B Stock to Flow thing is what like got the difficulty adjustment and having to click for me. And I was like so orange pilled, and I'm like at parties, like literally like doing the party meme, like boys and girls, anyone who'd listen, like it was just
boys and girls.
It didn't matter. So no, I don't. No amount of drinks get the Bitcoin pitch out of me at the local.
You're
college,
done now.
At the college.
They have to follow you on Twitter if they want if they want the real alpha.
Yep.
Awesome. Well, I've kept you for nearly 2 hours now. This has been a great conversation. I hope to have you on again soon. When you turn on laser eyes, we'll definitely bring you on. Before we wrap up, I like to end with some final thoughts. You have any final thoughts for our listeners?
No, man. This has been it's been an awesome chat. Fun 2 hours. I gotta piss.
It's fun doing it in person, right?
Yeah, it is. It's a ton of fun.
The studio is fucking ridiculous,
dude. I love it. It's great.
Well, the pleasure's been mine. Thank you for joining us, and a huge shout out to the freaks who joined us in the live chat, who listened to the show, who share with friends and family, and who support it with Bitcoin. Couldn't do it without you. I appreciate you all. I know the last 2 episodes have been a little different for Dispatch, but this is a different kind of year, so we're having fun with it. But the next Dispatch will be in 2 days in the morning. A nice morning rip on a very technical Bitcoin conversation about Miniscript.
Nice.
So definitely tune in and let's learn together, because I don't quite understand it either, and those are the most fun conversations.
Love it.
Until then, I want to thank Dylan again for joining us. I want to thank Rod for sitting on the couch while I ribbed him. I want to thank the freaks for joining us. And remember, freaks, stay humble, stack sats. Love you all.
Do I get to